tonight at 5:15 p.m. on the West Coast, 8:15 on the East. For Cultural Excellence, got a recording artist. That's Big Steve be on tonight with us, so you don't want to miss it. So now, ladies and gentlemen, it's time for the World on Finance with your host, Mr. Everett James. Hey, El.
Yes. Are you able?
Hello.
How's my
Yes, sir.
audio?
Audio is fine. Audio is perfect. Absolutely.
Fine. That's
So,
great.
boy, I know you have a lot to talk about today. What's on the agenda?
Well, okay. First off, an update on the OBBB. You know, the one big, beautiful bill that just passed
Mm.
July 4th. And then we're going to, I'm going to just share 9 things that you may not know about Social Security, since so many of us rely on Social Security for our needs. And then we'll look at regular information that will assist you in filing your 2025 tax return.
All right. Well, looking forward to it, Ev. I'm sure it's going to be a great show. I'm looking forward to the information.
Thank you
Thank you, my
so much.
friend.
Thank you so much, Mr. Brown, and welcome, listening audience. This is Everett James, your trusty tax reporter, who comes to you every Wednesday morning at 10 a.m. on the West Coast and 1 p.m. on the East Coast. We invite your participation. Please, if you have a question or if you have a comment, share it, with this station. And you can do that by contacting us either by phone or by email for those who are more comfortable with using that form of transmission. But our phone number is 951-522-9877. That's 951-522-9877. Or our email is evjtax1 at gmail.com. That's evjtax1 at gmail.com. And just the numeral, do not spell out the one. Okay, this is quite a significant time in our tax and our financial history. After the signing of the OBBB, the one big beautiful bill that you've been hearing about, which got signed on July 4th, on time, as our leader, Donald Trump, had predicted. What are some of the key aspects? I mean, certainly it was a bill that covered not only tax policy, but spending cuts, and then some energy related provisions. What are some of the key aspects of it? Well, number one, it increased our standard deduction that is used whenever a person chooses not to itemize on the Schedule A. When you look at the type of returns that folks are submitting, it's getting to the a point where it's almost unusual to see a return that uses the old Schedule A itemization form. And that's there's plenty of reasons for that, not the least being the fact that you get a greatly increased deduction when you use the standard deduction as opposed to itemizing it. However, I certainly do recommend the use of the old traditional Schedule A for those folks who find that they can come up with more legitimate deductions using the Schedule A. The some of the things that got improved and changed with the OBBB, the one big beautiful tax bill, the standard deduction. Well, and the whole purpose of this legislation has been to act on expiring tax provisions from the 2017 Trump Tax Cuts and Jobs Act that was passed in 2017 and took effect in 2018. And the number one, the standard deduction that had been increased in the 2017 law, this bill that our president just signed permanently increases the standard deduction, really meaning more folks can reduce their taxable income without having to itemize on the Schedule A. And that standard deduction is well ahead of and well above what most folks can itemize. The child tax credit, well, that got it has in 2017 and prior, it had been much lower than it is now. It had the legislation in 2017 increased it from $1,000 to $2,000 per child. The current omnibus bill increased that federal tax credit from $2,000 to $2,200 to $2,200, and also the legislation potentially expanded eligibility and refundability. The SALT deduction cap, that is the state and local income tax deduction cap, for years and years, taxpayers could deduct whatever amount of state and local income taxes they had paid. And that's important to make a statement about that they had actually paid, not just that they had been billed for, but actually paid. But the state and local income taxes for years was allowable to whatever state and local income taxes had been paid by the taxpayer. But the current omnibus bill, is something that has been set now, has been moved from $10,000. It was $10,000, from limited to $10,000 from the 2017 tax law. But now that limitation has been greatly increased, and it's been increased from that $10,000 that had been set up from 2017. It increased it from $10,000 to $40,000. That's a 3 zeros, $40,000. And that is going to remain in effect for 5 years. So in 5 years, from the 2025 tax reporting year, it will be in effect for 5 years, and it got increased all the way up to $40,000. And as I mentioned, it will be in effect for 5 years. So essentially, that would apply to everybody whose income does not exceed $500,000 or $500,000. There was a large number of tax breaks that were targeted, and the taxes were removed for tips, for overtime pay, going all the way back now to auto loan interest. Wow. In addition to a special deduction for seniors who are over the age of 65. So no more taxes for tips, overtime pay, auto interest, loan interest, and then there's, in addition, they threw in a deduction for seniors over 65 years of age. The Trump uh, on the tax bill that just got passed and signed on July 4th creates new tax advantaged accounts for children. And they will be getting the government and potential employer contributions. So employers could, contribute to that. The newly signed OBBB, one big, beautiful bill, is really a very comprehensive piece of legislation with a lot of impacts on various areas, particularly our policy, tax policy, spending cuts, and some energy-related provisions. The standard deduction, as I mentioned, got increased. The child tax credit got boosted up to $2,200 per child. Salt deduction limitation on Schedule A got greatly increased to $40,000, up to a max of $40,000 over the next 5 years. And of course, as I mentioned, this bill included temporary deductions for tips, overtime pay, auto loan interest, as well as an additional deduction for seniors. How does it affect the business community? Well, the bonus depreciation has always been an important item in business deductions. The current omnibus one big beautiful bill permanently extends the bonus depreciation, the 100% bonus depreciation that allows businesses to immediately deduct the full cost of property. The current legislation that was passed also covers research and development expenses. It allows immediate expensing of domestic research and development expenditures. As far as Section 179 deductions, that increases the Section 179 deduction limit for expensing of certain business assets, and it makes the that's Section 199A deduction, that is what's called the qualified business income deduction. That makes it, the recent legislation makes it that deduction permanent. That's very, very important because there is a QSBS expansion that expands benefits for the sale of qualified small business stock. In addition to these provisions, the omnibus bill that just was passed does cancel funding for a number of programs under the IRA, the Inflation Reduction Act. That is the legislation that took place under Joe Biden. and so a number of those things were terminated. The bill accelerates the termination of the energy tax credits, and it does provide enhanced access to federal lands for oil, gas, geothermal, and coal industries. So this is quite a significant, piece of legislation. It is really will go down as the largest tax cut in history for middle and working class Americans. According to the Joint Committee on Taxation, the tax bill will most benefit workers and families, interesting enough, making less than $50,000 per year. Bigger paychecks of 10,000 plus or more it does provide a larger take-home pay for families. As I mentioned, no tax on tips or on overtime, and no taxes on Social Security. It did provide a $12.5 billion modernization of our air traffic control system. Wow, how important is that, considering some of the air accidents that have occurred within the last few years. It permanently increased the child tax credit for more than 40 million families. It permanently secures our borders by finishing the border wall and hiring thousands of new ICE officers and Border Patrol agents. It drives down more energy costs with a massive expansion of domestic oil and gas production capacities. It really is. And the one creative thing here is that Trump accounts for every new American newborn child that is who is created. It strengthens Medicaid by eliminating waste, fraud, and abuse, and hopefully blocking illegal immigrants from receiving Medicaid. Medicaid will be the subject of some of our discussion this morning, particularly as it affects California. The bill does restore fiscal sanity by cutting $1.5 trillion in spending. It strengthens Medicaid by eliminating waste, fraud, and abuse, and hopefully blocking illegal immigrants from receiving Medicaid. It funds the Golden Dome missile defense system to confront 21st century threats. It modernizes our military to ensure it has the resources to be ready with lethal fighting force after 4 years of Biden-era weakness. So this bill is been significant, and I'm sure we'll be mentioning it many, many more times as we move into the 2025 tax filing season. Folks, we have, here it is, July 9th. Here it is, approximately 6 months away from the end of the year, and it really is a good time to concentrate on what you're doing or what you should be doing in preparation for that inevitable time of filing your tax return for this current tax year. I will be sharing some tax tips very shortly. In the meantime, I'd like to just go over something that many of us, since many of us receive Social Security, 9 things you just may not know about Social Security. First, benefits are paid in the month following the month for which they are due. When you're eligible for Social Security, the check you receive is for the prior month's benefits. For example, you'll get your July benefits in August. Social Security makes this annual cost of living adjustment to benefits due in December. So beneficiaries see the increase in their January checks. Payments are typically made on Wednesday based on your birthday. For example, if you were born on the 1st through the 10th day of the month, you'll receive your payment um, ba- on the second Wednesday of the month. If you're receiving benefits based on someone else's earnings record, payments will be based on the primary beneficiary's birth date. Okay. If you move, number 2, you should always notify Social Security, even if you have direct deposit, which is the case for most beneficiaries. Social Security needs to have the correct address on file so it can mail you important documents. If Social Security cannot contact you, it will stop your benefits. Let me repeat that. If Social Security cannot contact you, they will stop your benefits. Number 3, if your Social Security overpays your benefits, you'll be required to pay at least some of that money back. Every year, Social Security sends out billions of dollars in overpayments to beneficiaries. The overpayments may take place because Social Security received incorrect information about their income, or made an error, or just the agency itself made an error in calculating benefits. Whatever the reason, Social Security has the right to demand that beneficiaries refund the overpayments, and the terms of those refunds have really become tougher. Social Security now says beneficiaries must refund 50% of the amount that they are overpaid. It's a big increase from the 10% refund required for overpayments before that date. So it jumped up from 50% from 10% to 50%. Number 4, benefits withheld through the earnings test won't disappear forever. If you file for Social Security before you reach full retirement age, what is full retirement age? That's 66 for beneficiaries born between 1943 and 1954, gradually increasing to 67 for beneficiaries born after that. The Social Security will withhold a portion of your benefit after your earnings exceed a certain threshold. Number 5, there's a maximum benefit you're eligible to receive at full retirement age. Remember, it's 66. For those who were born before 1943, I'm pretty sure that full retirement age was age 65. So there's a maximum benefit if you're eligible to receive money at full retirement age. Social Security uses your highest 35 years of earning. That's sort of interesting. It's indexed to a national average wage index, and that includes your primary insurance amount. In other words, the benefit you qualify to receive it at full retirement age. If you have fewer years or fewer than 35 years of earnings, each year with no earnings just will be entered as a zero. Now, there is a limit on how much you can receive, no matter how much you earned during your working years. Now, if you reach full retirement age in 2025, The maximum monthly benefit is $4,018. That's sort of interesting, folks. It says the maximum benefit is $4,000. That's up from $3,800 last year. But you can increase your check by waiting. The biggest way to increase that Social Security check is just waiting to file for benefits. That's for many people, including this reporter. It was something I could not manage. I could not manage that wait. If you postpone claiming benefits until age 70, your monthly benefits will grow by 8% a year until then. You can get an estimate of your benefits for any age between age 62 and 70 by contacting the Social Security Administration at www.ssa.gov/prepare/plan-retirement. Again, that's www.ssa.gov /prepare /prepare plan-retirement. Okay, and the sixth thing that you might not know, your children may qualify for benefits. Now, if you're eligible, for benefits and have young children, they may qualify too. Your children or your child must be younger than age 18 or younger than 19 if still in high school. Unless he or she is disabled, benefits will stop when your child reaches 18, turns 18. Or as I say, benefits will stop when they reach 18, or if your child's in high school. Benefits will last until they graduate or 2 months after they turn 19, whichever comes first. Dependent grandchildren are also eligible for benefits. Again, dependent grandchildren are also eligible for benefits. Number 7, if you're receiving Social Security benefits when you reach 65, you'll automatically be enrolled in Medicare. This automatic enrollment includes Part A of Medicare, which covers inpatient care in a hospital or skilled nursing facility, and Part B, which covers doctor visits and other outpatient care. So, if you have health insurance from your employer or from your spouse's employer, you can decline Part B, which charges a monthly premium. If you're approaching age 65, you aren't receiving, and you're not receiving Social Security, and you want Medicare coverage, you should contact Medicare 3 months before your 65th birthday. And folks, that's where a lot of folks fall down. They don't contact Medicare before their 65th birthday, and there is a penalty for that. So if you're approaching 65, are not currently receiving Social Security, and you want that Medicare coverage, you should contact Medicare 3 months before your 65th birthday, and be sure to do it before your 65th birthday, because many people who haven't done that wind up losing money in the long run and having to pay additional money in the future. Number 8, Social Security pays a lump sum death benefit to surviving spouses. In 2025, Social Security will make a one-time payment of $255 to newly widowed spouses of beneficiaries. This payment is often referred to as a funeral benefit, but you can actually use it for anything you want to. Number 9, Social Security does not pay benefits for the month of death. Social Security uses the same rule it applies to living beneficiaries to determine eligibility after a beneficiary dies. A beneficiary must live an entire month to qualify for benefits, and benefits are not prorated, by month. So, for example, if your spouse dies in July, the check received in August, which is for July benefits, must be returned. If your deceased spouse had direct deposit, contact the financial institution so it can return any payments received after death. Okay, so those are the 9 things that you may or may not have been aware of, and things that I will be repeating from time to time because of the high likelihood that many of the folks who are regular listeners are receiving Social Security. Keep in mind that Social Security right now, unfortunately, is on a really unsustainable path. It's really still facing this enormous shortfall. It really is insolvent. Within the next 10 years, no one will be able to avoid this reality. And that's despite decades of politically expedient denial by our nation's top leaders and legislators. Yet, as of today, both presidential all presidential candidates, to include even Donald Trump, have long since announced they won't even touch the program. In fact, Mr. Trump really wants to make it more insolvent by either cutting back or eliminating taxes that seniors pay on benefits. So most people, of course, love the lower tax rates and so forth. But while reducing Social Security taxes, it may encourage some seniors to go back to work. It will, in turn, cause more dramatic problems if not paired up with reforms to Social Security benefits, something neither Trump nor any of the previous candidates cares to recognize. Social Security is right now in a big, big financial mess. Current benefit taxes bring in about $87 billion in revenue every year, in addition to the payroll tax revenue. Even still, Social Security is insolvent. Currently, it's projected that the main Social Security trust fund will dry up by 2033. Can you believe it? That's 8 years off. According to the Committee for a Responsible Budget, exempting Social Security benefits from taxation would move that date forward to 2032. It'll also dry up the Medicare trust fund 6 years sooner. So really, should you care? Well, just be aware that the law requires that when that happens, when Social Security reaches that date of insolvency, Social Security benefits will have to be cut, will mandatorily be cut by 23% unless Congress reforms the program, which has, up to this point, has not happened, and certainly is not going to happen, considering the fact that our current president has said he's not touching it. So if Congress and the administration decide to maintain the benefits and pay for them with borrowed funds, the U.S. Treasury will have to borrow $39 trillion over 30 years. And that's on top of $77 trillion already borrowed for Medicare. Now, this, of course, will be in addition to the already large deficits uh, and debt we've already incurred. The shortfall will even be larger without taxes on the benefits. So it's worth remembering that insolvency is, in fact, the reason why these taxes were adopted in the first place. The decision to tax benefits really didn't happen until Reagan's years and back in 1983, when the program was already in financial trouble. Additional taxes and an increase in the payroll tax were seen as a necessary means to keep the program solvent. Congress, however, should have reformed that program more fundamentally back then. The way the program was designed, it really has baked in the eventual insolvency. But all of our Congresses have taken a politically convenient, less responsible, more expedient route. Today, we're paying the price for this political cowardice. Lifting taxes on Social Security benefits would also be very unfair. Contrary to common belief, seniors are really overrepresented in the top income quintile. As Brian Riedel, a commentator, has written, seniors have the lowest poverty rate of any age bracket, and their average household incomes have grown 4 times as fast as the average worker since 1980. Comparatively, younger people currently paying for seniors' benefits are more likely to be in the bottom of the income distribution. In this way, Social Security redistributes benefits from lower to higher income Americans. Lifting taxes would make this inequity even worse. So, seniors are already getting more in Social Security benefits than they paid in. According to the Urban Institute calculation, a married couple with 2 average earners retiring in 2025 will receive $831,000 in benefits over their lifetimes, but will have only paid in only about $783,000 into the program, an adjusted net present value. The bottom line is that some seniors could absolutely absorb a reform in benefit. Lifting taxes on these relatively well-to-do seniors instead is a slap in the face for a lot of younger and poorer current workers. The bottom line is that exempting Social Security benefit from taxation is not a great idea. So why propose it? Well, votes. Because politicians get rewarded for when they promise to enrich voters, promise to increase their incomes, including showering them with cash. Whatever voters play in this mess, the greatest threat to Social Security really isn't the current tax structure. It's really a willful political denial of the program's impending insolvency. The time for meaningful reform is now, apparently not now, according to what President Trump has obtained in recent legislation. But the time for reform is now, before the fiscal and financial realities force a lot more drastic and painful measures in the future. So hopefully that does get more people thinking about reform that really, currently from all political candidates from the last election and President Trump have ignored that need, a necessity to meet. Okay, what's been going on the Medicaid front? Well, Gavin Newsom out here in California, he's expanded that illegals access to Medicaid, really setting the stage for a lot of red states just to foot the bill. His Medi-Cal expansion really has sparked new controversies. Reports reveal the cost of providing health care to illegal immigrants in California. It's being propped up by federal dollars from other states. Though the federal law blocks illegal immigrants from enrolling in Medicaid, California has found a way around it, and it's costing taxpayers everywhere. And it's it's this is one of the things that the Medicaid changes in the new law. And the new law is supposedly endeavoring to prevent. California's found a way around it. They use a combination of provider taxes and inflated service charges. California set up a system that triggers automatic federal matching payments. While the state appears to increase the Medi-Cal budget, the additional costs are passed on to insurers, and the insurers are then reimbursed, allowing the state to receive extra federal money without spending its own money. Analysts at the Economic Policy Innovation Center say this financial tactic could bring in over $19 billion in federal dollars between 2023 and 2026. That report calls that approach just a form of Medicaid money laundering, with funds devoted toward programs that include long-term care for wealthy residents and health care for illegal immigrants. The Medi-Cal, which is the state's version of Medicaid, now includes approximately 1.5 million undocumented individuals. That's about 10% of the total 15 million total enrollees. Think of that, folks. 10% of those folks receiving Medicaid in California are illegal immigrants. That expansion cost was expected to reach $6.5 billion, but it's jumped to $9.5 billion. And the state, California, has requested $6.2 billion in loans to cover the difference. Now, Newsom admitted the cost of providing care to illegal immigrants is a factor in the state's growing health budget. Still, as his administration insists, other states are facing similar financial pressures, including Colorado, Indiana, and Pennsylvania. While California's budget maneuvers have drawn attention, Oregon, our neighboring state, has also approved illegal immigrants to receive Medicaid through its state-funded plan. What's important for us to recognize that neither states, Oregon nor California, has been stopped by federal authorities. In Congress, Republicans are moving to close that loophole. The House and the Commerce Committee has been given the task of identifying nearly $900 billion in cuts. Limiting the Medicaid match formula or removing the safe harbor rule could reduce the ability of states like California to shift the burden of illegal immigrant care onto federal taxpayers. Wow. So this just to share with you an article from the Southern California News Group dated June 29th to 25. California budget deal cooks the books to hide deficits. Legislative leaders would have us believe that the 2025-2026 budget agreement they forged with Governor Newsom this week is noteworthy, even heroic, caused by factors, as they say, beyond their control. Well, and they blame it, of course, on President Trump's tariffs. The Unfortunately, since January, circumstances have changed, they said, and they say now California faces a significant budget shortfall. It goes on to cite, to a modest degree, the costs of key programs, particularly Medicare, have grown faster than projected. And third, it's grown to a smaller degree to the negative economic impacts of of the LA fires. Well, really, that scenario is really fictional. It's conjured up to mask the fact that Newsom and legislators have been overspending revenues for 3 years, ever since the government in California erroneously declared that state had almost $100 billion in surplus. But that was long before the fires hit LA and long before Trump was inaugurated. Newsom's revised budget started the blame it on Trump syndrome, and the legislative leaders quickly embraced it to explain away their chronic failures to either reduce spending or raise taxes to balance income and outgo. That's a condition known in the Capitol as a structural defect. And that's, as I mentioned, known in the Capitol as a structural defect. Unfortunately, the accompanying the gimmickry takes a lot of forms, such as delaying $2.3 billion in support payments to community colleges and local school systems that are due in June of next year, but they are going to delay it until a month later, thus shifting the responsibility from one fiscal year to another. Were a private corporation to cook its books like the state government does, its executives could wind up in jail for fraud. For some strange reason, however, California voters continue to tolerate the Capitol's chronic fiscal malpractice. Okay, folks, with that, we'll take a quick look at some of the things that you should be aware of. Keep in mind that we're looking forward to your comments and your questions. And please send or communicate those questions by either calling our phone number, 951-522-9877, or by sending us an email at evjtax1@gmail.com. That's evjtax1@gmail.com. Don't write out the one, just put the numeral in. Okay, that, as you mentioned before, one big beautiful bill not only passed the House and Senate, but was signed on July 4th by our leader, President Donald Trump. Happy to deliver his key legislative campaign priority. Well, I tell you, the Republican leaders have been able to overcome a lot of hurdles. They include complaints about higher federal deficits, cost-cutting measures used to offset tax breaks, grim poll numbers, complex procedures used to pass the bill in the Senate, Trump's tight time frame, and in-party fighting between moderates and conservatives. I'll tell you, lots of backdoor deals were made in this bid to secure the Republican holdouts. Here's some examples. The main example really is that $10,000 limitation on state and local deductions, and that was increased to $40,000 to get the support of Republicans from high tax states. A tax breaks for whalers and clean energy easings helped to lure Senator Lisa Murkowski, Republican from Alaska, and a break for the tax industry pushed by Senator Rick Scott, a Republican from Florida. The Republicans' use of budget reconciliation procedures complicated the process. And the budget reconciliation, as you may have heard, require only a simple majority vote in the Senate, but it has lots of technical rules. So those things really did help. Okay, well, the for your notes in claiming some child care dependent care credits this year, those dependent care credits, the babysitting expenses, in other words, that really took the cake as far as increased credits, much more than the child tax credits, which were really the vehicle and the roadmap to larger credits. But this year, the really was the deductions on Form 2441, which is the dependent care credit. That is the babysitting child care credit. And keep in mind that those are expenses for care of your kids who had to be at the end of the year in order to claim those dependent care credits. Age 13 had to be under the age of 13 by the end of the tax year. In addition, if you have qualifying relatives, that you're taking care of, and if you're out working or looking for work, you have to be in either one of those two categories in order to take that deduction. You have to either be working or looking for work. If you're taking the child a dependent care credit to help care for a relative who is not a qualifying child, such as a aging parent, and believe me, that is really just grown exponentially. The number of aging parents who folks are taking care of. It won't be long before the number of aging parents will match or become close to the qualifying children under the age of 13. But if indeed you're taking that credit for a relative who is not a qualifying child, such as I meant is an aging parent, that person needs to live with you for more than 6 months during the year, and has been unable to care for himself or herself. So again, those are really important qualifications to even take that dependent care credit. That the person needs to live with you for more than 6 months during the year, and is unable to take care of himself or herself. Now, as I mentioned, you calculate that credit on Form 2441. The one big beautiful bill would make that credit more generous, of course, and for 2025, that dependent care credit is worth 20% to 35%, up to $3,000 in care expenses. That's $6,000 if you have 2 or more dependents needing care. That makes the maximum credit for 2025. That sets that maximum credit at just over $1,000 for one dependent and $2,100 for 2 or more dependents. The one big beautiful bill would make the credit worth 20% to 50% of up to $3,000 in expenses, $6,000 for 2 or more dependents. That would make the top credit $1,500 or $3,000 for 2026. So if you're a working parent who would qualify for that dependent care credit, check whether your employer offers a dependent care FSA benefit option that you could fund with pre-tax wages. For 2025, you can contribute up to $5,000 to this flexible spending account, the One Big Beautiful Bill would increase that limitation to $7,500 in 2026. So for 2025, you can contribute up to $5,000 to this flexible, spending account. Employers that provide child care for workers can get a tax credit to offset up to 10% of the child care resources and referral expenditures. So if they're spending that, money on child care resources and referral expenditures, the employees could get a healthy tax credit. And as I mentioned, it could offset up to 10% of the money they spent for resources, and up to $5,000. You can contribute up to $5,000 to that to this spending account. This One Big Beautiful Bill would increase that limitation up to $7,500 next year. The employers that provide child care for workers can get a tax credit to offset, as I mentioned, up to 10% of child care resources and referral expenditures, and up to 25% of facility costs. So the maximum annual credit would be limited to $150,000. Use Form 8882 to claim that credit. One question that we get asked, quite a bit: how long should people or folks keep individual tax returns? Well, you should keep the 1040 for at least 3 years. That's how long IRS has to question items on your return and bill you for any additional tax that would be due. It's also the timetable should you want to file an amended return and want a refund. Now, IRS can go back up to 6 years if over 25% of your income is omitted from your return. So keep in mind, if you're thinking in terms of just deleting or not owing up to 25% of your income, and you admit up to that amount from your return, IRS can go back 6 years. If over 25% of your income is omitted from your return. Now, if fraud is proven, there is no limit. They can go all the way back. State tax return may have to be retained longer periods of time. You may want to keep some returns and tax records for more than 3 years. I would say, particularly if you're in business, or if you've had significant a sale of property, such as your own personal property or business sales. Hold on to records that establish tax basis of securities or real estates that you've sold, and hold on for those records for at least 3 years after you dispose of the property. If you've made non-deductible contributions to IRAs or post-tax pay-ins to 401ks, save your records until 3 years after the account are depleted. If you inherit property that you might eventually sell, you'll need to know the date of death value of the asset again. If you inherit property and in the back of your mind you eventually might sell it, hold on to that date of death value of the asset. That is the value of the asset on the date that the owner at that point had. And the owner, if that owner passed away and he died, you need to keep that date of death value. So keep that well past 3 years after you sell the property. So don't worry if you need information on a tax return that you've thrown out. There are a few ways to get a tax transcript, and that's what is a transcript? That's a summary of key data on your return. But if you don't have an online account, you can set up an online account with IRS and just go into it on your own. But if you don't have one, you can call IRS toll free at toll free 1-800-908-9946 to have a transcript sent to you. Or you just may submit a form 4506-T by mail. Folks who are seeking copies of tax returns must request them by mail. If you're going to do that, you have to use a form 4506. And I do see that I'm reaching the end of our presentation this week. And keep in mind that we are here to help you in so many ways, not just to know the law, but also to apply it to your advantage. So if you rent out a vacation home for more than 14 days in a year, keep in mind the rent is taxable. Your rental expenses can be deducted proportionately to the properties used as a short-term rental. How much you take is really determined by dividing the number of days you rented the home by the combined total days of personal and rent use. So again, how do you know how to do it, deduct proportionately? It's determined by dividing the number of days you rented the home by the combined total days of personal rental use. The deductions cannot exceed your total rental income, which is reported on Schedule E of your 1040, along with your rental-related expenses. Okay, so I think that will end this week's presentation, and we look forward to seeing you next week, or hearing from you next week.
All right. All right, there. Hey, great information there. Guys, keep it locked right here on the Buzz. You can check out each and every Wednesday on this network, 10 a.m. on the West Coast, 1 p.m. on the East. Ev, great information, my friend.
Thank you.
All right. And come back tonight for Cultural Excellence. Got a recording artist. Big Steve will be on, and that's 5:15 your time, Ev, 5:15 your time on the West Coast, and 8:15 on the East. In the meantime, folks, stay cool and keep it locked right here on the Buzz. All right, guys. Thank you so much for tuning in, and tell your friends about it, okay? You can find us a host of ways.